Hello and welcome to my morning note. When you think of junk bonds, you probably think that their great era was back in the 1980s, the time of Michael Milken and even Gordon Gekko. But in fact, you'd be wrong. The heyday for junk bonds is happening right at this moment. Yields have never been lower, and remarkably, given the recession we've been going through for the last few years, defaults have never been lower either. What is going on, and can this really be sustainable? With me now to discuss this is the head of Global Fundamental Credit Strategy for Deutsche Bank, Jim Reid. Jim,
hi there.
Thanks for joining me again. Let's start by taking a look at yields on US B-rated corporate debt. Really quite astonishingly lower even than what we thought were unsustainably low levels before the crisis. What gives?
Yeah, well, I mean, in 2009 you had the record high yield in single Bs, and in 3 or 4 years you've gone to the other end and had all-time lows. I mean, the demand for fixed income is incredibly high at the moment, and I think this is as big a part of this as anything else.
Can it really get any tighter than this, given that you're supposed to be doing this for a high yield?
Yeah, I mean, it's a difficult one because the macro conditions are still pretty weak. Economies that these companies are interacting with are still fairly weak, but it's the technical demand and the flow of money that goes into fixed income, searching for a yield, that is driving these lower. And while the fundamentals I'm not particularly keen on, I think the technicals are still very strong.
Okay, now let's take a look at the very long-term fundamentals. This is the default rate as derived by your own exhaustive annual default rate study. This is extraordinary. How have default rates managed to be this low for this long?
Yeah, I mean, credit analysts are probably having to tear up everything they've learned through the decades that the growth of the economy is important for defaults, because the actual last 10 years when defaults have been low have been pretty weak for the economy. But I think it's the demand for fixed income, and I would say that for the last 10 years the demand for fixed income has been artificial relative to the past, and that has allowed companies to finance at lower and lower yields, which has led to less of them defaulting.
Does that mean that in many ways what we're seeing here is artificial forbearance, that companies are surviving when perhaps it would be better for the creative snap, crackle and pop of capitalism if they went under?
I think there's an element that for a healthy economy over the medium term, defaults and recessions are a great thing. And what worries me about the longer term growth outlook is that we're suppressing those forces, and this is kind of showing in the default rate on the chart here.
Okay, and one other point, if we can move on to the next chart from your study, which is also rather interesting, is that they've not only financed at cheap rates, they've locked in that financing for quite a long time to come.
Yeah, and what this chart shows you is when the refinancing is needed in dollar amount in the high yield market in the US, and you can see that what you would normally expect to see here is the hump occur maybe 3 or 4 years time. Right. And what we're now seeing is that the hump has been pushed back often 5-6 years in advance, as the ultra low borrowing costs and the huge demand for fixed income has allowed companies to borrow in ways that they've never been able to borrow before. So
it's not just lower rates for these relatively high risk companies, it's also they're getting these loans for much longer terms.
Yep, and that's the kind of paradox of markets at the moment. The fundamentals aren't great, and the credit analyst that I was 10 years ago would say that those fundamentals would be very negative for defaults. But we live in a new world of kind of artificial demand for fixed income, which is kind of pushing this out.
What could break this? I mean, a disorderly route in the sovereign market, or what?
I think if you're looking for things, one obvious thing is if you did have a normalisation in the fixed income market, then I think that would be bad news for defaults. It's quite ironic that you think normalisation is bad news, but I think this is an area where you want an artificial market to sustain the status quo.
Okay, so Jim, thank you very much indeed. We live in a very strange world. You might not have noticed it, but this was a fantastic time to be betting on very risky companies. And for the reasons Jim's given, while this rather strange environment we continue to live in of QE and artificially low rates persists, there's really no reason, despite all your instincts to the contrary, to get out of credit.